a lot of people will ask, well, how do you know which stocks to gamma scalp on? And the answer is actually not that complicated. You're going to gamma scalp when you need to. That's the answer. You see, people think that when you introduce a strategy, that strategy has to have certain market conditions associated with it. You already chose a strategy. Your strategy was the straddle. And you thought the market was going to move big, either way up or way down. And when it doesn't, gamma scalping is the defensive technique. And I stress that, defensive. It is the defensive technique that you can use to help you make a little bit of money while the stock takes its own sweet time in moving in your direction. In other words, we're doing something to help offset time decay until the stock makes its big breakout move that you've been looking for. So that's the notion of gamma scalping. And what gamma scalping necessitates, in order for you to be successful at gamma scalping, you pretty much have to sit in front of the screen all day, because you're not looking for moves at the end of the day. You're looking to capitalize on those intraday moves in which you can buy and sell stock. Because think about what you're doing. When the stock goes down, you're buying stock. And when the stock goes up, you're selling it. And therefore, you're buying the stock lower and you're selling the stock higher. So you're actually looking to make stock. You're actually looking to make money from your stock position. Okay? You're looking to make money. Why are you looking to make money with the stock? Because it's going to help you in the short run. It's going to help you offset some of that time decay element that's part of your the purchase of the straddle. And gamma scalping is a defensive technique that we use on long straddles or long strangles in order to help us make a little bit of money while we're waiting for the big breakout move that we had predicted sometime earlier. So that's gamma scalping. And as you can see, you're looking for intraday moves. Whenever you get an intraday move, you go ahead and you buy or sell stock. That's a lot of work. Okay, it's a good technique to know, but it's a lot of work. So a lot of traders just to simply decide that's not what they want to do. They want to do, maybe they feel better trading the opposite, which is scalping the short gamma. This is what we refer to as reverse gamma scalping, and let me explain how that works. You start out with the notion that you think that the stock is not going to move. Okay, it's a different prognosis from the very start. You don't think the stock is going to move, and therefore you sell a straddle. And for the beginners where you've been told all your life through the beginning of option trading that selling naked options is bad, you're probably cringing at this point. Okay, so let me just tell you that this is the introduction. We'll show you how to correct for it. I just put up the example of selling a straddle. I'll show you more sensible positions for those of you that are new, but I put up the example of selling a straddle just so you understand the notion of what I mean by reverse gamma scalping. As you look at the picture of the short straddle, what you see is that now as the stock goes down, your short put gains more and more deltas. And since you're short put, your delta gets more and more positive. Positive deltas make money when the stock goes up. So if you have more and more positive deltas as the stock goes down and more goes lower and lower and lower, that's not a good thing. Okay, so eventually we want to correct for that. On the other hand, if the stock goes up, our delta gets more and more negative because our short call option starts to really become dominant. So as the stock goes up, the more and more it goes up, the more and more money you lose through delta. This can be frustrating. So again, what do we have here? We have a position in which we don't want the stock to move. And if the stock doesn't move, then we're going to make money through the daily time decay and through a possible volatility crush by having this short straddle position. That's what we're looking for. We're looking to sell a straddle, and we're looking to make money through time decay and through a volatility crush. Unfortunately, while we're looking to make money through time decay, and through a volatility crush, the stock might move. And if it does, it's going to make us feel a little bit uncomfortable because we're going to start losing money due to that move. So reverse gamma scalping is the technique that we're going to use to address the problem of having the stock move in either direction. Okay? The goal here is to keep as much of the premium of the short straddle as possible. Reverse gamma scalping is going to help us deal with the one thing that we can't control, which is the stock moving up or the stock moving down. Okay? So the idea here is as the stock moves up, we get more and more negative deltas, we're going to have to buy stock. As the stock moves down, we're going to get more positive deltas, and that means we're going to have to sell stock. Because ideally, we would like to remain delta neutral throughout this process so that we can make money through the time decay element and through the volatility crush. Notice that what this means is that you're going to be buying the stock higher than where you put on the trade, and you're going to be selling the stock lower than where you put on the trade. So this goes counter, and what it means is, and this goes counter to what a lot of people are comfortable with, obviously. What it means is your stock transactions are going to lose money, okay? But the idea is you're willing to lose a little bit of money in order to avoid losing a lot of money, okay? You're going to lose a little bit through reverse scalping of the stock. And you hope that the little bit that you lose is not as much as the amount that you're going to make through the time decay element in your trade. So that's what you're trying to do here. This is one of those slides for which you're just sit back and enjoy it. Make sure that you get the slides at the end of, you know, if you haven't already registered, make sure you register and get a copy of the slides so you don't have to write them down. Reverse gamma scalping, or RGS, as we stated, is the opposite of long gamma scalping, which is the first thing that I explained. It's usually implemented by traders who want to sell options as they believe that implied volatility levels are going to decline. In other words, you're expecting some sort of a volatility decline, if not a crush. You're also expecting to make some money through the time decay element. Now, selling a straddle is the most basic way to create a short gamma position. But as you know, it has inherent risks. And many traders set limits on how much risk they're willing to take on any particular trade. Therefore, rather than use a short straddle, we're going to look at other positions that you may consider trading rather than a short straddle, similar to a short straddle, but without the unlimited risk of a short straddle. So we're going to get into that a little bit. As the market declines, the short gamma will gather, because you're short gamma, you're going to gather long deltas. In other words, the further down the market goes, the longer your delta position will get. And as I said earlier, you don't want long deltas in a declining market. On the other hand, if the stock goes up, you'll get short deltas. And nobody wants short deltas in a rising market. So reverse gamma scalping is the technique that we're going to use in order to defend ourselves against the stock moving in either direction. So again, reverse gamma scalping is also a defensive technique.